looking at items on our balance sheet. In FAR 2, we looked at current assets and current liabilities. We talked about cash and cash equivalents. We looked at accounts receivable, inventory. We talked about accounts payable, contingencies. Now, in FAR 3, we started with looking at investments, which could be current or non-current. Now, in this section, we'll talk about PP&E, which stands for property, plant, and equipment. So that's a non-current asset on the balance sheet. So let me put it here, PP&E. So let's say we got a piece of land, that's property. We got a factory shed on that land, that's plant. And we got machinery, we got tools, we got furniture, fixtures, some delivery vehicles, all that's equipment. Now, for PP&E, we include all costs that were incurred to put that asset into intended use. For example, for land, property, you would include your purchase price, any broker commissions that you paid, title recording fees, legal fees, surveying charges, any costs that were incurred for clearing, grading, landscaping, or site development. Now, let's say you had an old building there and you demolished that old building. The cost of demolition, that's included in the value of land. Now, what you reduce from the value that's included in here for land is any proceeds from the sale of scrap. Let's say you bought a tract of land which had a lot of trees. You sold those trees out as timber. So those proceeds that you received from the sale of timber, that's reduced from the cost of land. Let's say you had the old building which you demolished and you sold off the building materials. So that's again reduced from the cost of land. Now, when you're talking about land, that's different from land improvements. Now, land does not depreciate. In real world, land actually appreciates. So we don't depreciate land. But when we're looking at land improvements, let's say the fencing around the land, some sidewalks, water system, lighting. So all that is land improvement which depreciate over time. So you record land improvements separately from land. Now let's move on, look at plant, building. So in building, what you have is you include the purchase price. Let's say you made some alterations and improvements in the building, capitalize that. Architect fees, maybe some deferred maintenance. Those are basically repairs neglected by the previous owner. Now, if you constructed your own shed, your own factory building, in that case, you would also include any capitalized interest during construction. So you borrowed money for construction, the capitalized interest during the period of construction is also included in PP&E. Now, we'll talk about capitalized interest in the next section. So let's move on, equipment. So when you're looking at equipment, you would capitalize your purchase price. Any transportation cost to get that equipment to your factory. So freight in, installation cost, some test runs of equipment, any sales, excise taxes, legal fees. Also, if it's self-developed, if you constructed that equipment on your own, you could include capitalized interest during the period of construction. Now, once again, for self-constructed fixed assets, so you could construct your own building, you could construct your own equipment. So you would include the cost of direct materials, direct labor, any direct overheads and variable overheads, plus capitalized interest during the period of construction. So if you realize we are including only costs, if you're constructing it on our own, we are only including the cost for construction. We're not including any profit. Let's say we're buying it from somebody else, that person, he would have some profits on that. But when you're doing it on our own, no profits out here. Also, we look at basket purchases. So let's say you go out and buy land and building together for a lump sum price. In that case, you might want to use relative fair value of the land and of the building to allocate that lump sum purchase price that you paid between land and building. So guys, though I'm telling you PP&E, you have separate line items. So you have separate line item for property, a separate line item for plant, that's your building, a separate line item for equipment. So you could have, within equipment, you could have machinery, you could have furniture fixtures, you could have vehicles. So separate items for all of these. So let's get to the book, look at the intro on PP&E and we'll come back with lots more. We're looking at tangible fixed assets. So tangible fixed assets, that's PP&E. So highlight property, plant, equipment. Highlight include all costs incurred to put the asset to intended use. Highlight land cost, and that includes the purchase price, any commissions, fees, charges, any existing obligations assumed by the buyer, any cost of clearing, grading, landscaping or site development, cost of raising or demolishing an old building. So put a bracket there and write getting land ready for intended use. And highlight less proceeds from the sale of any scrap like building materials, timber, etc. Highlight land improvements and underline depreciable, and that is why they are recorded separately from land cost. Highlight building cost, highlight equipment cost. And then on the third bullet on this page, we're looking at self-constructed fixed assets. So put a box around that. And that includes highlight direct material, direct labor, direct overhead and variable overheads. And you can also have capitalized interest during the construction period before occupancy begins. And we're going to talk about that in a couple of pages. So right there,
page F316.
we got basket purchases there, where we need to allocate the purchase price based on appraised fair value of the individual items purchased. So if land and building were acquired for underlying lump sum price, in that case we use highlight relative fair value method to allocate the value between land and building. Now, if you have interest cost incurred during the construction period of any of PP&E, that interest cost is capitalized on your balance sheet. So guys, we're talking about interest cost on self-constructed PP&E. Let's say we are building our own factory shed. The interest cost incurred during the construction period, that would be capitalized as plant or factory shed on our balance sheet. But if we buy a factory shed which is ready to use, even if we borrow money for buying that factory shed and we pay interest on that, it becomes an interest expense. Because that's not a self-constructed PP&E. That is something we've bought ready to use. But only when we're constructing it on our own, self-constructed, can we capitalize the interest cost incurred during the construction period. Now that could also be for equipment, right? Let's say we're building up our own equipment, own machinery. Now the interest cost incurred during the construction period, that could be capitalized as equipment. But if you're buying an equipment ready to use, borrowing money on that, paying interest, that interest is an interest expense. So for self-constructed fixed asset, we can capitalize interest during the construction period. Now this would be a sort of avoidable interest, right? Think about it. If we had not constructed the PP&E, the interest would have been avoided. So this is avoidable interest. Now, what you need to remember here is we are capitalizing interest on PP&E, but we do not capitalize any interest on inventory. Now, what you do not capitalize here is interest incurred before commencement of construction. Let's say you started construction at this point, and at this point you completed construction. We are looking at avoidable interest during the period of construction. Before commencement of construction, no, that's an expense. After your construction is completed, again, that's an expense. We are only looking at during the period of construction. Now, let's say you've borrowed money in excess of the amount spent. Even that's an expense, doesn't get capitalized. If you have certain intentional delays in construction, even that goes an expense, not capitalized on your balance sheet. Now, ordinary delays, that's okay, that happens. But intentional delays, do not capitalize expense out on your income statement. Now, let's look at calculations for capitalization of interest. And I'm looking at one of the examples that you have on your book. Now it says, Miles Company takes a 10% loan of $500,000. So 10% interest loan on $500,000 on 1st Jan 2009 to finance construction of own use building, of which $300,000 is spent evenly during 2009. Balance $200,000 is spent evenly during the first 9 months of 2010. Construction completes on 30th September 2010. Assume that the interest on the $500,000 is payable for the entire year in 2009 and 2010. Compute capitalized interest for 2009 and 2010. Okay, when I'm looking at capitalization of interest, now we would capitalize lower of actual interest cost incurred. So in this case, we borrowed the entire amount of $500,000 on day one. So what's the interest cost incurred for 2009 and for 2010? So for $500,000, 10% rate of interest, $50,000 for 2009 and another $50,000 for 2010. But the entire amount borrowed was not used for construction. So now we are looking at the weighted average accumulated expenditure into interest costs. So weighted average accumulated expense into the interest cost. Let's try to calculate this from this problem. So let me draw a timeline out here. So we got 2009 and 2010. Now what we're saying is during 2009, $300,000 was incurred evenly during the year. So what you could say is a year has got 12 months, 2009. $300,000 was incurred throughout this year. Something like, let's say, $25,000 per month. Now, if I'm looking at that figure of $300,000, if I'm saying it's incurred evenly during 2009, some part here, some part here, some part here, evenly during the year, if you're looking at the interest cost for the year, we can simply multiply it by half. And then the rate of interest is 10%. So we could say $300,000 into half, $150,000 into 10%, that's $15,000. So the actual interest cost incurred during 2009, that's $50,000. But if you're looking at the weighted average accumulated expenditure, that's only $150,000 into 10% gives us $15,000. Now let's look at 2010. When I'm starting the year here, we already have made an expense of $300,000. So that $300,000 is for the full year. But wait, not for the full year, because construction completes on 30th September. So at this point, so September 30th, construction completes. So I told you, right, we are capitalizing interest only during the period of construction. Before construction starts or after construction ends, no more capitalization of interest. All that is expense on your income statement. So if I'm looking at this $300,000, this is for the entire 9 months. So $300,000 into 9 by 12. Now this would be into 10%. So 9 by 12 becomes 3 by 4, $75,000 into, so this becomes 75,000 into 3, 225 into 10%, $22,500. So that's for the $300,000 which was incurred in 2009 as of 1st Jan 2010. That was already an expense made. So that would be interest for the period of construction in this year. What was the period of construction in this year? 9 months out of 12. Now during 2010, we again incurred $200,000 which was spent evenly during the first 9 months. So now if you're looking at the balance, $200,000, we're looking at half of it because it was spent evenly. So let's say $200,000 over 9 months. So some amount was spent in January, in Feb, in March, up till September. So that becomes half. So mid-year, midpoint, into 9 by 12, because again we are only looking at the 9 months during the year, not the entire year, into 10%. So this would give us $7,500. So guys, once again, for the year 2009, we didn't have any expense incurred before 2009 because the construction started on 1st Jan 2009. During this year, we incurred $300,000 of expense, but that was evenly throughout the year. If all that expense had been incurred as of a particular date, we could say, because it's evenly throughout the year, a little bit in Jan, Feb, March, April, May, June, July, up till December, we could say if we decide one point in which this entire expense is incurred, that would have been the mid of this year. Let's say that would have been 1st of July 2009. So all the expenses going out during the year. Midpoint for that would be 1st of July. So what would be the interest cost capitalized had all the expense been incurred on 1st of July? That would have been $300,000 into half of the year into 10% gives you $15,000. Now for the next year, we are now looking at $300,000 into 9 by 12. Why? Because $300,000 is the beginning. So that was already incurred in 2009. So that remains incurred for 2010 until construction is complete. When is construction completed? September 30th. So 9 by 12 into 10%, that's your interest cost, interest rate. Now, you have the balance $200,000, which is again incurred during this period, during the first 9 months. Now, if you're looking at a midpoint, we are multiplying it by half and by 9 by 12 into 50% into 75% into the 10% rate of interest. This gives you $7,500 interest expense. So $22,500 plus $7,500 makes it $30,000. So what you could say is for 2010, the interest cost, the actual interest cost incurred is $50,000. But the weighted average accumulated expense into interest cost, that is $30,000. Now, we will capitalize the lower of these two. So, if you're looking at a journal entries here, so we would pass a journal entry where we are capitalizing interest cost incurred during production or during construction. So, you have P, P and E, which is getting capitalized. And then the balance would go into your interest expense. And then cash is going out for the entire amount of interest incurred. So guys, what we are saying is $15,000, that is something we're going to capitalize here. $15,000 we are capitalizing. So this is for the year 2009. So we're capitalizing $15,000. The balance $35,000, that goes as an expense on our income statement. So 35 goes in here. Total cash, $50,000 during 2009. For 2010, we are capitalizing the lower of these two. What is lower? $30,000. But how much was actually incurred? 50. So the remaining 20, that goes on your income statement as a non-operating expense. So that becomes $20,000, 50 in total. So these are the journal entries that you would have for the 2 years. So guys, understand what we're doing here. We're saying instead of the entire amount of $50,000 being interest expense, some portion of that is being capitalized on your balance sheet. It's not being expensed here, it's been capitalized. So instead of expensing the entire $50,000 as interest expense, we're saying no, $15,000, that is avoidable interest. That interest would have been avoided had this building not been constructed. On page 16, we're looking at capitalization of interest for self-constructed fixed assets. So it says interest cost incurred highlight during the construction period. And they need to be capitalized into the asset because that's highlight avoidable interest. The third bullet there, circle the not because you do not capitalize interest costs incurred underlined before, so that's before commencement of construction, and underline after, that's after completion of construction. Then we're looking at calculation of interest cost, which we capitalize, that is highlight lower of, highlight weighted average accumulated expenditure into interest rate, and highlight actual interest cost incurred. So it's lower of these two. Now, we just saw this example on capitalization of interest on our board. So let's just write the journal entries for both the years on the bottom of this page. So for 2009, right, PP&E debit $15,000, interest debit $35,000, and cash credit $50,000. So though the interest paid was $50,000, 15,000 of that was capitalized as PP&E. The remaining $35,000 was interest on the income statement. For 2010, debit PP&E for $30,000, interest $20,000, and cash went out, cash credit $50,000. So though the interest cost incurred, the actual cost was $50,000, only $30,000 of that cost was capitalized as PP&E. The balance was interest expense on the income statement. Now, we might be incurring a lot of expenses on PP&E, on property, plant and equipment, even after we acquire them. So think about it. Let's say repairs and maintenance expense on your factory building, your factory machinery, all that is cost of goods sold on your income statement. Let's say you're trying to repair or maintain your office computers or your office headquarters, your administrative block. That's your G&A expense, general and administrative. If you're trying to repair your delivery trucks, your selling warehouses, that is all selling expense on your income statement. So guys, we've been talking about repairs and maintenance expense which help you maintain the PP&E at the current level. All that is revenue expense on your income statement. Now, how about certain expenses which help you make your PP&E bigger, better, or longer? So guys, these are basically capital expenditures which instead of going to your income statement, go on to your balance sheet. They increase the value of your PP&E. So they are capitalized and depreciated over a period of time. So instead of coming to your income statement right today, they'll be coming to your income statement slowly as you depreciate them over a period of time. So I've been talking about capital expenditures now, and we are looking at expenditures which make PP&E bigger, better, and longer. So let's put that on the board there. So guys, when you think about athletes, Olympics, you think of faster, higher, stronger. Now we CPAs, we are no less than athletes. We think of bigger, better, longer. So when I'm talking about bigger, I'm talking about additions to PP&E. So let us say we've made certain extensions, certain enlargements, certain expansions. All that makes our PP&E bigger. So for example, we have a factory building, a factory plant, and we've added a new wing. That makes our factory, that makes our PP&E bigger. So the journal entry in this case would be PP&E to cash. Guys, think about it. PP&E to cash. So your PP&E here, this goes into your balance sheet. Now, if this was a normal, a recurring repair and maintenance, you would have debited expense, repairs and maintenance expense. Repairs and maintenance expense, that would have gone to your income statement. Now we are trying to capitalize the expense, capital expenditure. We're trying to capitalize it, and we're going to be depreciating it over a period of time instead of putting it all on the income statement right today. So this was about making your asset bigger, additions to your asset, extensions, enlargements, expansions, new capacity. Now, when you're looking at better, we're looking at betterments to the asset. So this could be, you could say, increasing the efficiency of the asset or the productivity of the asset. So either efficiency goes up or productivity goes up. Basically, in simple terms, the asset becomes better. So let us say we got a factory building and we've just installed a fire sprinkler system. That makes our plant better. Let's say we've just installed a HVAC. That makes it better. You could also have reinstallations and rearrangements making your plant better. Let's say we had a big gym which nobody used. So what we did was we converted that gym into 25 workstations. Now that makes our asset better because it's more efficient, more productive now. We've got 25 people working in a place where nobody used to go. So guys, even that could be better. And again, when we're looking at the journal entry for better, we are having the same journal entry because it's adding value to our asset. It's PP&E to cash, where PP&E, this is going to your balance sheet, and that's why we're calling it a capital expenditure. Now, let's get to the dashboard now. So what I've been trying to tell you is, if it's a revenue expense, it's an expense debit to cash. So the expense could be COGS, selling, G&A. Now we're looking at capital expenditure, where we're saying PP&E debit to cash. So we're increasing the number for PP&E on our balance sheet. Now guys, if you remember, when we did accounts receivable, we had a contra asset called allowance for doubtful debts, where we were not sure. So it was accounts receivable less allowance give us net accounts receivable. Now when we're doing PP&E, we have another contra asset which we call accumulated depreciation. Let me put that on the board here. So you have PP&E less accumulated depreciation. So what you do is you have this PP&E on your balance sheet. Now every year as you use this PP&E, there's wear and tear. PP&E might get obsolete. So what you do is every year you have an annual charge, an annual depreciation of PP&E. We'll talk about depreciation in the next section, but when you depreciate PP&E, your journal entry is depreciation debit. So depreciation is an expense which comes onto your income statement, and accumulated depreciation credit. So basically, instead of directly hitting on the number for PP&E, you create a contra asset called accumulated depreciation. So let's say if I bought equipment for $100 and it's going to last 10 years and I do straight line depreciation over 10 years, at the end of year 1, I'll have $10 as the depreciation expense here, less 10 accumulated depreciation, net 90. At the end of 4 years, accumulated depreciation is going to be 40 and the net is going to be 60. At the end of 8 years, this is going to be 80 and net is going to be 20. So guys, that's accumulated depreciation, a contra asset to PP&E. Now, if we have a capital expenditure which makes the asset longer, so we're looking at bigger, better, and now we're looking at longer. So if we have a capital expense which makes our asset longer, basically which increases the useful life of the asset. So this could be a major or extraordinary repair. It could be an overhaul which increases the useful life of the asset. So guys, here we were looking at increase in efficiency and productivity. Here we're looking at increase in useful life. So if the capital expenditure actually increases the useful life, what we do is, instead of increasing PP&E, we reduce accumulated depreciation. Now, accumulated depreciation, that's a credit balance, it's a contra asset. To reduce accumulated depreciation, you got to debit it. So instead of debiting PP&E, you debit accumulated depreciation. So guys, I'm sure you're getting this concept. So when we said it's a revenue expense, the debit was to an expense. Cash goes out. When we said capital expenditure, which make our asset bigger or better, PP&E debit. But if it made our asset longer, increase the useful life, we debited accumulated depreciation, which again goes to our balance sheet. So we had PP&E less accumulated depreciation reported at net on the balance sheet. So it doesn't make a big difference as such, but here you're impacting the PP&E number, here you're hitting on the accumulated depreciation number. So an example of making your asset longer could be, let's say we've repaired the roof of the building, or maybe we've repaired the plumbing system. So all that could make our asset longer. It lasts longer than it was originally supposed to be because of this major or extraordinary repair. Now, in this context of capital expenditures, let's also look at refurbishments. So basically, at times what you might do is, you might take an old asset out and put a new asset in. Basically, replace an asset. So let's look at how do we account for refurbishments. Let's get on the corner of the board there. Now, whenever you have such refurbishments, your question is, do you know the carrying value of the old asset? So if carrying value of old asset is known, let us say you know the carrying value of the old asset. We have an HVAC that we had for our building. Now we feel, that's not so good. We need to have a better technology in place. So we take the old HVAC out, strip it off the building, put a new HVAC in. So when we're stripping the old HVAC off, that old asset is going out, and nobody might be ready to buy it. We might just be scrapping it off. So guys, we know the carrying value of the old HVAC. So what we would do is, we would credit PP&E for the old asset, old HVAC. Now, there would be some accumulated depreciation. We would have depreciated the old air conditioning system. So we would have accumulated depreciation. And this is on the old asset. So that becomes the book value. And we're just scrapping it off. We're not selling it because nobody's ready to buy it. It becomes a loss. This loss goes to the income statement. So now this is the old asset going off the books. Because we know the carrying value of the old asset, we're taking the old asset off the books, and on the books now we're going to have a replacement. We're going to have a new asset coming in. For the new asset, we're going to have PP&E debit to cash. So this is for the new asset, which makes our PP&E better, because now we don't have the old HVAC which never worked. We have the new, more effective, more productive HVAC, PP&E to cash for the new asset. Now, if the carrying value of the old asset is not known, let's say we're changing the roofing of our factory shed, and we don't know how much we spent for the roof. We put the value of the entire building together. We didn't have a separate number for the value of the roof. So if the carrying value of the old asset is not known, then the question is, do you want to account it as better or longer? Now that depends on whether the refurbishment or the replacement is increasing efficiency or increasing useful life. So if you know the carrying value of the old asset, simply do take off the old asset and PP&E to cash. If you do not know the carrying value of the old asset which is going off, take a call whether the efficiency is increasing or useful life is increasing. If the efficiency is increasing, use this journal entry, PP&E to cash. Now guys, in this case, we are not taking the old asset off. Why? Because we do not know the carrying value of the old asset. We just take carrying the new asset in. Useful life is increasing, reduce accumulated depreciation. Again, you're not taking the old asset off because you do not know the carrying value. So guys, a quick recap here. We're looking at capital expenditures which impact the PP&E number on your balance sheet. We're not hitting the income statement right away. We're going to capitalize it and depreciate it over a period of time. So if the capital expenditure makes your asset bigger or better, bigger means you are adding to it, better means you're improving efficiency or productivity, you debit PP&E, naturally cash is going out. So you increase your PP&E number on your balance sheet. If the capital expenditure makes your asset longer, it lasts for a longer life, basically what we would say is we need to reverse off the depreciation that we've already taken. We need to reduce accumulated depreciation. So that's basically your core concepts. Now, sometimes on the CPA exams, you have questions on refurbishments, replacements of assets. Now, in such cases, question number 1, do you or do you not know the carrying value? If you know the carrying value, simply take the old asset off, give the new asset in. If you do not know the carrying value of the old asset which is going out, then you have to take a call whether efficiency is increasing or useful life is increasing. If efficiency is increasing, PP&E to cash. If useful life is increasing, accumulated depreciation to cash. So guys, this is the basic concept on capital expenditure. Let's go to the book, look at this, and then we'll come back. And now we're going to talk about depreciation debit to accumulated depreciation. We'll talk about how do we depreciate our fixed assets, our PP&E. Capital expenditure. And these are highlight not normal or recurring expenses which increase the carrying value of the asset. Capital expenditure, they can make your asset bigger, better or longer. So let's put a box around bigger, another box for better and third one longer. And the column for bigger, highlight extension, enlargement or expansion. Highlight new capacity or new functions. Under the column for better, highlight improving efficiency and productivity. And highlight reinstallations and rearrangements with material benefits. For longer, highlight extends the useful life. And a good example is highlight overhaul. Now, looking at the journal entries, for bigger, debit to asset, credit is cash or payable. So highlight asset and cash. For better, it's the same journal entry, the debit to asset and the credit to cash. But for longer, the debit is to highlight accumulated depreciation. Credit could be cash or a payable. Now, let's look at refurbishments or part replacements. Highlight carrying value of the old asset is known or identifiable. In that case, you got two journal entries. The first journal entry, write old part equals write off. The old part is now written off because that is being replaced. And the second journal entry, write new part purchased. So if you know the carrying value of the old asset, basically you pass journal entries for the sale or disposal of the old asset, and then the new part that's purchased is treated as better. Next one, highlight carrying value of the old asset is unknown or unidentifiable, in that case, you would treat the new part that's coming in as underline better if it increases efficiency and underline longer if it increases useful life. So we've seen that when we go out and buy PP&E, buy property, plant and equipment, all the costs, all the expenses that we incur to put the asset into intended use is capitalized on the balance sheet. We've also looked at capitalization of interest. That's when it's a self-constructed PP&E and the interest is for the period of construction of, let's say, the building or the machinery. Then we also looked at capitalization of certain major expenditures which make our PP&E bigger, better or longer. Now let's talk about expensing this PP&E over a period of time, rather allocating the cost of this asset to the periods benefited. So we're going to depreciate PP&E over its useful life. So as I told you, we're going to have depreciation expense on the income statement. Now, the depreciation expense could be part of COGS if it's relating to factory building or relating to production. The depreciation would be G&A if it is relating to administration, office. It could be selling if it's related to selling expenses. So, we're going to depreciate PP&E over its useful life. So, it's going to be a depreciation expense on the income statement, and it's going to be accumulated depreciation on the balance sheet. So let's look at the journal entries. So when we buy PP&E, let's say we've got PP&E debit to cash and we went out and bought PP&E for 10,000 bucks. And let's say we made a couple of estimates. We said that, this equipment is going to last 4 years. And after 4 years, it's going to be worth $2,000. Basically, the salvage value of this equipment after 4 years, $2,000. So we made a couple of estimates. We can say salvage value is $2,000 and that's after the useful life of 4 years. Now, let's try to depreciate it straight line over the useful life. So $10,000 is going to be worth $2,000 after 4 years. So for the next 4 years, we want to depreciate this PP&E using straight line at $2,000 per year. So we want to have depreciation expense and accumulated depreciation. Guys, think of it. Instead of having accumulated depreciation, we could also have done a depreciation expense debit, depreciation expense. This goes to your income statement. And we could have hit PP&E, which goes to the balance sheet. So let us say if you're taking years 1, 2, 3 and 4. So year 1, year 2, year 3 and year 4. This is a factory machine and we're going to depreciate it $2,000 in year 1. So $2,000 in year 1, $2,000 in year 2, $2,000 in year 3 and $2,000 in year 4. So we're going to have depreciation expense, $2,000 debit, PP&E 2,000 credit. This is going to be for years 1, 2, 3, 4. On the balance sheet, we're going to have PP&E at $10,000 when we went out and bought PP&E. At the end of year 1, this is going to be worth 8,000. At the end of year 2, this is going to be worth 6,000. At the end of year 3, 4,000. At the end of year 4, it'll reach the salvage value of $2,000. So that is exactly how we wanted to move. But then instead of hitting PP&E directly, we create a contra asset which we call accumulated depreciation. Guys, I often correlate this with the concept that we learned for accounts receivable bad debts with what we learned for contingent liabilities. Look at this. expense debit, liability credit. It's a contra asset, sort of a liability. So there we had bad debt expense to allowance for doubtful debts. So bad debt expense, that went to your income statement. Allowance for doubtful debts, that was a contra accounts receivable. Similarly, now we have depreciation to accumulated depreciation. Now accumulated depreciation, that's a contra asset to PP&E. So let me put it all here. So PP&E less accumulated depreciation. Now when we want PP&E at $10,000 historical cost, we'll keep having this number $10,000 here. So let me use the blue pen for this. At the end of year one, we're going to have depreciation to accumulated depreciation. So accumulated depreciation, that's going to have a credit balance. But since we are putting it on the asset side of the balance sheet, it's going to be negative. So this is going to be $8,000. Now at the end of year two, accumulated depreciation is a cumulative number. So it grows from $2,000 to $4,000. So 2 plus 2, 4. So now you're going to have next $4,000 and the net PP&E is going to be $6,000. At the end of year 3, we're going to have a cumulative for 3 years. That's $6,000. So you're going to have $6,000 here. The net, that's going to be $4,000. At the end of 4 years, the cumulative amount in accumulated depreciation is going to be $2,000, $2,000, $2,000, $2,000, $8,000. So you're going to have less accumulated depreciation, $8,000, and PP&E is going to be at its salvage value of $2,000. So guys, that is the concept of depreciation expense, which is going on your income statement, accumulated depreciation, which goes on to your balance sheet. So basically what you're doing is you're trying to allocate the cost of this PP&E. You bought it for 10,000 bucks. You're trying to expense it out as you're using this PP&E, as it's having wear and tear, as it's getting obsolete, as you're generating revenues using this PP&E. Guys, think about it. Because you have this equipment, are you able to run your business, run your operations, generate sales? So you want to match the expense, depreciation expense over the period you've used this equipment. So that is the concept of depreciation. Now we have looked at depreciation via the straight line method. So what we've done is basically, if I'm looking at the straight line method formula, we've taken cost minus salvage value. Now salvage value, useful life, these were all estimates. So cost, we know that. That's something we've paid out. That's a certain number. But salvage value, this was an estimate. We've taken that and we multiplied that by 1 by useful life. So guys, for year 1, the cost was $10,000 minus salvage value $2,000. Salvage value, an estimate. Useful life, that's again an estimate. We're not sure. It might last 4 or 5 or 6, but we think it's going to be 4 years. So 10,000 minus 2,000, that gives you $8,000 by 4, that's $2,000. Now this base remains constant. So even in year 2, you have the same base, and the good thing is you got the same number here. So 1 by 4. In year 3, again, same number. Year 4, same number. So what you could actually say is for all the years, you're going to have the same amount of depreciation unless there is a change in estimate. Guys, I'm sure you remember that from FAR 1. Year 1, 2, 3, and 4, you're going to have $2,000 each year. So you're going to depreciate it by $8,000. At the end of 4 years, it's going to reach the salvage value of $2,000. Now, you could also go ahead and do accelerated depreciation. Let's say you decide to use the double declining balance method. So this is the first method we're doing, and then let's talk about the double declining balance. Now, in this case, what you do is instead of taking cost minus salvage value, you take cost minus accumulated depreciation. And if it was a simple declining balance method, you would have done into 1 by useful life. But we're doing double declining balance method. So double means you're going to depreciate it at double the rate. You're going to accelerate the depreciation. Instead of taking 1 year, you take 2. So guys, cost minus accelerated depreciation. This is declining. So this is a declining balance. I'll show it to you. 2, this becomes double. Hence the name, double declining balance or DDB. So what you do here is, in year 1, we're taking the cost minus accumulated depreciation. What's your accumulated depreciation in year 1? 0. You've just bought it. It's brand new. So you take $10,000 minus 0 and you multiply it by 2 by useful life. So 2, what's the useful life for? So basically 50% of $10,000, that gives you $5,000 of depreciation in year 1. Guys, look at it. Here we just had $2,000. Now you're accelerating your depreciation. Instead of depreciating $2,000, you're doing $5,000. Now in year 2, what's your accumulated depreciation now? So in year 1, you pass the journal entry. Depreciation expense debit $5,000. So instead of $2,000, you now have $5,000. Accumulated depreciation $5,000 in year 1. So at the end of year 1 or for year 2, you're going to have cost, that's going to remain $10,000. But your accumulated depreciation, that becomes $5,000. And you use the same number, 2 by 4. So 50% of this 10,000 minus 5,000 into 50%, that gives you 2,500 of depreciation in year 2. Now, after year 2, for year 3, your cost remains at $10,000. What's your accumulated depreciation? That's $5,000 in year 1 plus 2,500 in year 2. Remember, accumulated depreciation, that's a cumulative of depreciation because it gets parked onto your balance sheet. So that's $7,500. Now, when you multiply it by 2 by 4, you get 2,500 into 50%, $1,250. Now, wait a minute. We said that the salvage value of this asset was $2,000. But now if you look at it, let's put it on the dashboard. So this was the straight line method. Now we're looking at double declining balance method. Double declining balance method, first year $5,000 of depreciation, second year $2,500. So now it looks something like this. 10,000 less accumulated would be 5 plus 2.5, 7.5. Now in year 3, we're getting 1250. If you put this 1250 in place here, we're going to have 8750 of accumulated depreciation. And net is going to be 1250. Wait a minute, we said that the salvage value of this asset is going to be $2,000. How can we get it below salvage value? So now what we do in year 3, instead of taking 1250, we would take only $500. So in that case, what would happen is accumulated depreciation would be 7.5 plus 0.5, $8,000. And you'll have the net value of PP&E at $2,000, which is your estimated salvage value. In year 4, no depreciation. So guys, what we've done is we've taken a lot of depreciation in the earlier years, slowed down later. In straight line method, it was constant. Here, initial years, it was pretty high, then it slowed down, it lowered later. So let's get back again and look at this. So you have the depreciation expense debit, accumulated depreciation credit, and we have $5,000 in year 1, 2,500 in year 2. In year 3, instead of taking 1250, we're going to take just 500 because now it's going to be $8,000 accumulated depreciation. Now, you could use another accelerated method which we call the sum of the years digit. So let's do that on this board here. So number 3, SYD. Now what you do here is, again, you take cost minus salvage value. Because I want you to realize one thing. So in straight line method, the base was cost minus salvage value. In double declining, the base was not cost minus salvage value, it is cost minus accelerated depreciation. Basically, we did not use salvage value on a formula, but we stopped when we reached the salvage value. We stopped depreciating any further. Now in sum of the years digit, again, similarly you use cost minus salvage value and you multiply this by the sum of the years digit percentage. Now what you do in sum of the years digit, as the name signifies, so this asset is going to last 4 years. What is the sum of the years? So if I'm looking at sum of the years, I could say it's 4 plus 3 plus 2 plus 1. That's 4 plus 3, 7 plus 2, 9 plus 1, 10. Now I'll give you a formula to know this. So you could do n into n plus 1 by 2. So n is 4 into n plus 1 is 5 by 2, 20 by 2, 10. Now we could have done 4 plus 3 plus 2 plus 1 because it was just 4 years. How about the useful life was 10 years? Then you would have to do 10 plus 9 plus 8 plus 7 up till 1. Instead of that, you could have used this formula. You could have said 10 into 11. That gives you 110. Divided by 2, 55. So that gives you the sum of the years digit. So what you do in sum of the years digit percentage is, on the numerator, you would have number of years left. On the denominator, you're going to have this number. In this case, number 10. So 4 plus 3 plus 2 plus 1, or n into n plus 1 by 2. So on the denominator, you have this number. Numerator is number of years left. So let's try to do that. So for year 1, we're going to have $10,000 minus $2,000. So that's cost minus salvage value. Now you multiply this by how many years are left in the first year. 4 years are left. The asset is going to last another 4 years. So 4 by the denominator. Denominator is going to be 10. In the second year, you would say how many years are left? 3. 3 by 10. In the third year, how many years remaining? 2 years. Fourth year, how many years remaining? 1. So guys, I hope you're understanding what's happening here. We've taken 4 by 10, 3 by 10, 2 by 10, 1 by 10. So if you total this, 4 plus 3, 7, plus 2, 9, plus 1, 10. So we have depreciated 10 by 10, or we have depreciated the entire amount of $8,000 over the 4 years. Just that we've used accelerated depreciation. There's going to be more depreciation in the initial years than in the later years. Look at this. So $8,000 into 4 by 10. Now this gives you $3,200. Second years, $8,000 into 3 by 10. That gives you $2,400. $8,000 into 2 by 10 would give you $1,600. This would be $800. If you total this, 3,200 plus 2,400 plus 1,600 plus 800, that would give you $8,000 accumulated depreciation for 4 years. Same thing. So you're getting to the same result, just that here you're doing a straight line method. In these two cases, you're doing accelerated depreciation methods. More depreciation in initial years, lesser depreciation in later years. Now, you could also use the activity method. Basically, your depreciation would depend on how much you've used the PP&E, how much you've run the machines, let's say. So let me also teach you the units of production method, or the output activity method. And let us look at the example that we have on our book. It's a machinery bought on 2nd Jan 2001 for $10,000 with estimated useful life of 4 years and salvage value of $2,000. So we've already been doing that example now. Machine expected to have an estimated total output of 1,000 units over its life. Actual output was 150 units per year for 2001 and 2, and 200 units per year for 2003 to 2004. Now, what you do in this case is, the base is the same. So you have cost minus salvage value, and instead of the SYD percentage, you have the UOP percentage, or the units of production percentage. So here you're looking at how much was the machine run? What was the level of activity? So looking at year 1, year 2, year 3 and year 4. Your base, that remains constant. So $10,000 minus $2,000. Now this units of production basically says how much have you used it. So in 2001 and 2002, they've used it 150 units. And the total expected was 1,000 units of production. In 2003 and 4, it's been used for 200 units each year. So into 200 by 1,000 into 200 by 1,000. So basically if we see they've produced 150 in the first 2 years, 150 each, 300, 500, 700. The machine could have produced 1,000, but they produced just 700. We're going to depreciate based on how much they've produced. What's the level of activity? So $8,000 into 15%. So that gives you $1,200 here. This is again 1,200. This becomes 20%, that's 1,600 and 1,600. So this is basically depending on the level of activity, the amount of output. So guys, these are a few depreciation methods that you can use. Now guys, as you can understand, let's get back. So as you can understand, what we are looking at is what should be this number each year. We're looking at what should be a depreciation expense each year, which will naturally flow on as accumulated depreciation on your balance sheet. So if you're using straight line method, each year is going to be 2,000, 2,000, 2,000 and 2,000 as we have it here. If you're using double declining balance, you're going to have 5,000 in year 1, 2,500 in year 2, 500 in year 3, 0 in year 4. If you're using sum of the years digit method, you're going to have 3,200 in year 1, 2,400 in year 2, 1,600 in year 3, 800 in year 4. If you're using the units of production method as in our example, you're going to have 1,200 each in 1 and 2, 1,600 in 3 and 1,600 in 4. So guys, pretty simple, but what we are looking at is what's this estimate number which goes on our income statement every year, hits our income because it's an expense item, and what flows in as accumulated depreciation on the balance sheet. So generally if you use the straight line method or the accelerated methods, at the end of 4 years you're going to have an accumulated depreciation of $8,000 and the salvage value remaining here is going to be $2,000. So after 4 years, if you want to sell this asset, more or less you should be getting $2,000. Now guys, as I said, depreciation, it's an estimate. If your estimate is pretty accurate, then the number that you have here would be very close to the market value of this asset. So the value that you would get if you're selling this asset. Now the question is, I've given you 4 options here and there are many more. Which option do you select? Do you do straight line method or would you want to use accelerated methods? So in straight line method, what you assume is the asset, the PP&E gives you equal benefit each year. So $2,000 each year, same benefit. In accelerated method, what we see is there's better matching, because you could say that a new asset, a brand new asset is more productive than an old asset. So when the asset was more productive, we had a higher expense number. When the asset was less productive, we had a lower expense number. What you could also say is the accelerated method helps you even out repairs and maintenance expenses. Now think about it. If you have a new asset, a new equipment, there'll be pretty low repairs and maintenance. So you have high depreciation and low repairs and maintenance here. But when you get to year 4, towards the end of the life, you have lower depreciation, but the repairs and maintenance would be higher. So the sum of depreciation and repairs and maintenance, that would more or less remain constant. So that's a good thing. And if you're using accelerated method, that also minimizes any obsolescence loss. Let's say you bought some equipment and suddenly after 2 years, the technology was outdated. Because you used accelerated methods, the carrying value of this asset is pretty much low. So the journal entry there, highlight depreciation expense, put a circle around income statement, and highlight credit to accumulated depreciation and circle balance sheet. Now looking at the table for methods of depreciation, you got the straight line method and then you got a few accelerated methods. The first one, double declining balance, highlight historical cost minus accumulated depreciation. That's why it's called declining balance. And when you're looking at the double declining balance percentage, it's 1 by useful life, highlight into 2. That's why it's double. Hence the name, double declining balance. For DDB, under additional info, highlight salvage value is ignored. However, cannot depreciate below salvage value. For sum of the years digit, the trick is to calculate the sum of the years digit percentage. So highlight number of years left. This is divided by n into n plus 1 by 2. Now the third bullet on this page, where we are selecting a depreciation method, highlight straight line method, use if assets give equal benefit each year. For accelerated method, highlight better matching as asset is more productive in initial years. Highlight minimize any obsolescence loss, evens out expenses, and also highlight more tax benefits in initial years. Highlight activity method, and that is highlight depreciate based on usage, not time. We got a couple of examples out here. The first example on depreciation methods is what we just solved on the board. So we saw the straight line method of depreciation versus double declining balance versus sum of the years digit versus units of production method. Now the second example towards the bottom of this page is about partial period depreciation. So if the asset was purchased during the year, in the year 1, we need to determine the depreciation rate for the full year and prorate based on the fractional time under use. So you can look it up on your own, and let's move on and look at component depreciation versus composite depreciation. Now, before we go on further, let's do a quick analysis of all these methods of depreciation that we've just seen. So, if I look at the straight line method of depreciation, I could say that depreciation base here is constant. So, it's always cost minus salvage value, $10,000 minus $2,000. 1 by useful life, 1 by 4, even that is constant across years. The depreciation amount, even that remained constant. If I look at double declining balance method, cost minus accumulated depreciation, this depreciation base, this was declining. It was $10,000 in year 1, became $5,000 in year 2, became $2,500 in year 3. So this was declining. Remember, I pointed this out to you. That's why you call it declining balance method, and double why? Because it's 2 by useful life. Now 2 by useful life, though it's double, it's still constant across years. So we have 2 by 4, 50% across all years. So this one is constant. But because the base is declining, even though the rate is constant, we have a declining number for the depreciation amount across years. So the depreciation amount is declining. Let's look at sum of the years digit. Cost minus salvage value, this is a constant number. But when we're looking at the sum of the years digit percentage, the depreciation rate, that is declining. So you had 4 by 10, 40%, 30%, 20% and 10%. So this was declining. And because the depreciation rate was declining, the depreciation amount also ended up declining. When we're looking at the units of production method, cost minus salvage value, this number, this is constant. But the units of production percentage, the depreciation rate, that was variable. That depended on the activity level, can't be sure. So if you're looking at the depreciation amounts, even these are variable, can't be sure. Now, units of production, this is pretty much variable, depends on the levels of activity. But for the remaining three methods, let's try to chart it out. So if I can draw a chart where I could say this is time, so you have year 1, year 2, year 3, year 4, this is dollar depreciation. If you're looking at straight line method, it goes something like this. If you're looking at the declining balance method, so let's say the double declining balance method, this goes something like this. If you're looking at the sum of the years digit method, so this could be something like this. A straight line going down, so 3,200 to 2,400, 1,600 to 800. So I'll just try to draw a representative diagram out here for you to understand what's happening in each depreciation method. You generally won't get it on your exams, but still it's good to know. Now, let's get back and talk about component depreciation versus composite depreciation. So I'm looking at, let me use this part of the board. Component depreciation. And this is required for IFRS. Now, what you do in component depreciation is basically you take a fixed asset, you take a PP&E and divide it into separate components with different lives. So you have, let's say we buy a machine which comes in with a cylinder and an inspection required, let's say every 10 years. So the life of the machine, let's say, is 20 years. The life of the cylinder that comes in with the machine is 5 years, and it needs to be re-inspected every 10 years. Now, the three components, right? Machine, cylinder, inspection. So what we would do under component depreciation is divide that machine, the cost of the machine, into those three components and depreciate them based on the useful life of each component. That becomes component depreciation required for IFRS. Now, under GAAP, you could also use group or composite depreciation. Now, group depreciation, that's for a collection of similar assets. Let's say we got a fleet of delivery vans. That's a group. We can put it all together, depreciate it together. Composite, again, that's a collection of dissimilar assets with different useful lives. So let's say we got a building which has got furniture and which has got electrical installations. We can put all that together and do composite depreciation. Here we have split that into components. We would have building separate, furniture separate, electrical installation separate, different components here. Here we do it composite. We put it all together. So the building could last 50 years, the furniture could last 10 years, electric installations could last 15 years, but we put it together. We calculate a composite rate of depreciation that we use for the entire collection of assets. So group, similar assets, like a fleet of delivery vans. Composite, dissimilar assets, something like building with furniture and electrical installations. Now, one interesting thing that we have for group or composite depreciation is on sale or disposal of one of the items in the group. Now, because you use composite depreciation, you really don't want to complicate it a lot when you're selling one single item from the group. So what you do is, whenever you're selling out an item, one of the items from a group or composite depreciation bunch, you recognize no gain or loss on sale. So the rule is no gain or loss on sale. You assume that the cash that you received on sale, that was equal to the carrying value of the item which went out. So assume cash received is equal to carrying value. And the plug in this case is your accumulated depreciation. So this is when you're selling out one of the particular dissimilar assets from the entire group, or one of the assets, not the entire group or not the entire bunch, but one of the assets. So no gain or loss on sale. Assume that the cash that you got, the sale of one small piece, was same as the carrying value of that piece, and the plug is accumulated depreciation. I'll show you the journal entry for that. So let us say when you're selling out one of the pieces, you're going to get in cash. What's going to go out? PP&E is going out. And there's going to be some accumulated depreciation. Now, generally, we'll learn about this in a moment, that whenever you're selling PP&E, if you sell it for more than your carrying value, you would have a gain. If you sell it for less than a carrying value, you would have a loss. But in this case, you assume that there's no gain, no loss. So you would have cash coming in, you know the PP&E which is going out, the plug is your accumulated depreciation. So this was an interesting concept for group or composite depreciation. So let's look at this on the book and we'll come back with more. We're looking at component versus composite depreciation. Highlight component depreciation. Next, highlight group or composite depreciation. Highlight group, that's similar assets. And you can underline the example, fleet of delivery vans. Next, highlight composite, that means dissimilar assets. And the example there, underline building furnished with furniture and electrical installations. Then you have the gain or loss on, put a box around disposal of individual items. That's not recognized. So make a note there, right? Assume carrying value equals sale price. Therefore, no gain or loss on sale. And therefore, plug is accumulated depreciation. Now we got an example on composite or group depreciation where we have three different types of furnitures and fittings which are depreciated using the composite method. Now what we do is we first calculate the depreciation or composite rate, putting all the dissimilar composite assets together, and then we use that rate to depreciate the asset over its composite life. Now, in situations where you have many low-cost tangible assets, low-cost PP&E, let's say hand tools for a manufacturer or even utensils for a restaurant, I mean, in that case, you could also use the inventory method of depreciation. Inventory method, let's recall what we learned when we did inventory and COGS. Remember, your cost of goods sold on your income statement, that is basically beginning inventory plus purchases. Now this gave you the cost of goods available for sale minus ending inventory. This was the expense for COGS which went into your income statement. Now we could use a similar method for that for PP&E, those low cost equipment, low cost tools. Let's say beginning inventory of tools plus purchase of tools during the year minus ending inventory. That's the depreciation expense which goes into the income statement. So that was basically for low cost tangible items. It's not really preferred because it's not systematic or rational, but then again it's advantageous, especially when you don't want to maintain all the depreciation schedules for these small items. Now in this method we write appraise or value ending PP&E. And the depreciation expense, that's beginning PP&E plus cost of acquisitions minus ending PP&E. So guys, this sounds so much like the calculation of COGS, the cost of goods sold, that was beginning inventory plus purchases minus ending inventory. Now this method is typically used for low cost tangible assets. And make a note there. Think of PP&E as inventory and depreciation as COGS. And that's why this is called the inventory method of depreciation. Now we've seen that depreciation, that's based so much on estimates. This is an estimate number. So let's say we've salvage value, that's an estimate that we have. Useful life, that's another estimate. How about if these estimates change with time? So let's say we've estimated a salvage value of $2,000. Later we realize that the salvage value is only $1,000. Now we know from FAR 1 that changes in accounting estimate are accounted for prospectively. That means now and forward. So we don't go back and do any changes. But from now, we're going to use the revised estimate for this year and forward. How about change in depreciation method? So let us say we move from the straight line method of depreciation to the double declining balance method. Now a change in accounting method, that's a change in accounting principle. But we also learned that changes in methods for depreciation, amortization, depletion, though these are changes in accounting principle, they are treated as inseparable from a change in accounting estimate. So a change in method of depreciation is a change in accounting principle, but that change in accounting principle is inseparable from a change in accounting estimate and accounted for as a change in estimate prospectively. So straight line method to double declining or double declining to straight line, though it's a change in accounting principle, it's accounted for as a change in accounting estimate prospectively, now and forward. That's because depreciation, as I told you, is all about estimates made by management. We're talking about accounting changes relating to depreciation. Highlight change in accounting estimates, for example, the depreciation rate, useful life, salvage value. These are treated currently and prospectively as of the beginning of the year of change. Next, highlight change in depreciation method is a change in accounting principle inseparable from a change in accounting estimate and thus also treated prospectively. And this concept was something we've covered in FAR 1. So if you don't remember this, it's time for you to go back and revise. Now let's talk about depletion, which is depreciation of natural resources. Let's say you've got a mine from which you can extract removable ores. Now, as you keep on extracting, the value of the mine, that gets depleting because after a particular point in time, you'll have no more ores to extract. So at that point, the value of the mine would be zero or any residual value. Now, for depletion, we're going to use the units of production method. So you have this depletion base, so cost minus salvage value. So cost is going to be the purchase price that you paid for the mine, plus any development costs that you spent to get that mine up and running, plus any anticipated restoration cost. Now think about it. After you're done with your job, you got to clean up the place. You got to make sure there's green grass growing there. So that would be your restoration cost. So this cost includes purchase price plus development plus anticipated restoration cost. Salvage value, that's going to be the residual value. So after you clean up the place, you're going to sell it off. So that would be the salvage value that you're going to be getting later. So that becomes your base for depletion. You're going to multiply that by the depletion percentage, which is units extracted this year divided by the total estimated recoverable units. Let's think about it. We did the same thing when we did depreciation under units of production method. We said the percentage here is going to be the number of hours we ran the machine this year or number of units we produced this year divided by the total number of units expected. So similar thing here, number of units extracted this year divided by the total estimated recoverable or extractable units. Now, what you need to understand here is depletion. That is going to be included in your cost of goods sold. So after you extract your ores, you're going to be selling them. And the depletion expense, that's going to be included in your cost of goods sold. Now, how about you haven't been able to sell all that you extracted? So let's say you extracted 1,000 units and you could sell only 800 units, 200 units still lying in stock. So what you would do in that case is you would have sales for 800 units. The cost of goods sold would be for those 800 units that you have extracted and sold. The 200 units which are lying unsold would go to your inventory on your balance sheet. It would be expensed out next year when you sell them. So guys, the same concept that you had for inventory also applies for depletion, because that is the product cost. That's your cost of goods sold. So COGS is basically the units that were extracted and sold. Inventory, that's the units which were extracted but not sold. They are still in stock. Ending inventory as of the balance sheet date. We're looking at depletion. Highlight depletion base, which includes highlight purchase cost, development costs, present value of anticipated restoration costs, and from this highlight less residual value of land.
Now, when we're looking at anticipated restoration costs, that's asset retirement obligations. And we're going to cover that in detail on page 25. So right there, refer page F3 25.
Now, depletion is computed on the units of production method. So circle depletion. And the formula for depletion is depletion base multiplied by unit extracted by total expected recoverable units, which could also be interpreted as highlight units extracted multiplied by depletion base by total expected recoverable units. And put a box around depletion base by total expected recoverable units, because this one is your unit depletion rate. And now let's look at the example on depletion that we have on the second half of page 30. In 2010, Mine Company purchased a mineral mine for $2.2 million with removable ores estimated at 5 million tons. The property has an estimated present value of restoration cost of $400,000 after the ore has been extracted, with residual value of $100,000. The company incurred $500,000 of development costs preparing the mine for production. During the year 2010, 400,000 tons were removed and 300,000 tons were sold. So now, looking at the first part of the solution, we are calculating the depletion base, which is equal to cost of land plus development cost plus the present value of anticipated future restoration costs less residual value. This calculates to $3 million. Unit depletion rate, that's the depletion base divided by the total expected recoverable units, or $3 million divided by 5 million tons, calculates to 60 cents per ton. Now the second part of the solution, put a box around depletion for 2010, and that equals underline units extracted multiplied by the unit depletion rate. So 400,000 tons of units extracted during 2010 is multiplied by 60 cents per ton, which calculates to highlight $240,000. Now, the depletion for 2010 needs to be allocated between COGS and inventory. So, next line, depletion included in COGS. Put a box around COGS. And that is calculated as 300,000 tons sold, underline sold, into 60 cents per ton, calculates to highlight $180,000. And put a plus sign between COGS and inventory, because on the right we have depletion included in, put a box around inventory, and that is the goods which are not sold as of year end. 100,000 tons underline unsold. That's multiplied by 60 cents per ton, gives us highlight $60,000. So total depletion $240,000 is allocated $180,000 to COGS and $60,000 to ending inventory. Now, we just looked at this concept of depreciation, where we said we're going to reduce the carrying value of a PP&E every period as we use the PP&E, as there is wear and tear, as there could be obsolescence of the PP&E. So what we did was every period we had a depreciation expense on our income statement, and we created this account on a balance sheet called accumulated depreciation, which reduced the carrying value of the PP&E. So over the course of its useful life, slowly the value of the PP&E is coming down. Now, how about the value of PP&E falls much faster than we are depreciating it? This is a case of impairment. So guys, in real life, impairment, that's a disability. So even for fixed assets, impairment means that they will not be able to recover their carrying value, the net carrying value over the course of their useful life. So for example, let's talk about this camera right in front of me. Camera reels. So how about a machine which produces camera reels? Let's say we all use digital cameras these days. The demand for camera reels, that's significantly fallen. So we could say that this machine which produces camera reels may have been impaired. That means the carrying value of this machine may be even more than the value it's going to recover over the course of its useful life. So reasons for impairment. So as I said, decline in demand. Nobody uses camera reels these days. So this machine, the product, that's no demand. How about technology and competition? So let's say the technology of camera reels, that's not up to pace with the digital cameras. Decline in fair value of this machine. So nobody wants to buy this anymore. So if you want to take this to market, try to sell it, nobody wants it. The fair value has declined. There could be cases where there's net operating losses or negative cash flows from such equipments, from units having such equipments. So guys, all these would indicate that there could be an impairment.
On page 23, we're looking at impairment. Now, the circumstances that indicate impairment, that indicate that something may go wrong. Now, these circumstances include, let's say, a decline in demand for the products or services offered by the entity. It could be inability to keep up with technology or competition, new competitors coming in, new tech coming in. Decline in fair value, a net operating loss, the company is going through tough times, negative cash flow, or some changes in regulatory or legal environment. And then when we get to goodwill impairment, this is something that we're going to be covering in BAR, in Business Analysis and Reporting section of the CPA exam. We're going to talk about how loss of key personnel or an impairment loss by subsidiary could lead to goodwill impairment. The question is, how do we test, measure, and recognize any impairment losses? Now we've got a lovely table out here, where first we're looking at tangible assets, that's property, plant, and equipment, underlined held for use assets. Now on the second column, put a box around depreciate. Now for held for use assets, the answer is highlight yes. You have to depreciate it before you run your impairment testing. And of course, the next column, put a box around test. So this is when you test for impairment. Now, very interestingly, on the test for impairment, you're comparing, highlight the carrying value with non-discounted future cash flows. And the asset is impaired only if the carrying value is greater than the non-discounted future cash flows. Now, if this test for impairment is passed, which means the carrying value is actually greater than the non-discounted future cash flows, then we start to put a box around measure the impairment loss. Now, when we measure the impairment loss, it is basically highlight carrying value minus the fair value. Think of fair value as discounted future cash flows. And we'll look at this on the example. Once you've measured the impairment loss, underline you recognize loss and circle I. So this loss is recognized in income from continuing operations because it's a held for use asset. And something I want you to note, underline future write up and highlight no. So if an asset is impaired, if a held for use asset is impaired and there's a future write up, that means the value, the fair value of the asset recovers in the future, the reversal of impairment losses is not allowed. Now let's look at the same pieces for underlying held for sale assets. Now, for starters, for held for sale assets, you do not depreciate. So highlight no on the depreciate column. Now, when you do the test for impairment for held for sale assets, you're comparing highlight carrying value with NRV, net realizable value, which in a sense is fair value minus cost to sell. When you want to measure the impairment loss for these held for sale assets, it's calculated as highlight carrying value minus the NRV. And if there's an impairment loss, you're going to recognize it in circle D or discontinued operations line item. Next, let's talk about future write-ups or reversal of impairment losses for held for sale assets. Now, this is something that we covered back in FAR 1. We discussed that under US GAAP, reversal of impairment losses is allowed for held for sale assets. So highlight yes. Now we got a few notes on this page. First one, highlight for testing impairment. This is for held for use assets. You got to use undiscounted net future cash flows. But for measuring impairment, as we've seen above, you got to use fair value, which is basically discounted future net cash flows. Now, the third note that we have here, highlight for held for sale assets, use NRV, which is fair value less cost to dispose. And then the last sub-bullet, highlight for held for sale assets and indefinite life intangible assets and goodwill, the test for impairment is conducted at the same time every year. On page 24, we're looking at the journal entries for recognizing impairment losses for highlight tangible assets as well as intangible assets with definite life. Basically, we're looking at depreciable tangible assets or amortizable intangible assets. And the journal entry here is the debit is highlight impairment loss and the credit is to highlight the accumulated depreciation or amortization. So guys, as I say, impairment oftentimes is like an erratic form of depreciation or amortization. Something goes wrong and impairment kicks in. Let's now look at the example that we have on this page. So you have camera company which purchases machinery on 1st Jan year 1 for $10,000 and is depreciating the machine over 10 years by straight line method assuming zero salvage value. On 31st December year 3, development of new products has caused the output of the machine to be less valued in the marketplace and the company believes that it will be able to generate future cash flows of $3,600 over its remaining life. The asset has an estimated fair value of $3,000. So basically, the discounted future cash flows is $3,000. The non-discounted is $3,600. Now, I want you to make a little bit of notes below the box for the example, right? Carrying value for the asset, right? After depreciation. So the asset was purchased for $10,000 and assuming that it's been depreciated year 1, year 2 and also year 3, the carrying value after depreciation will be right $7,000. Right? The non-discounted future cash flows, and that's the number which is given on the example, is right $3,600. And then fair value, which is nothing but the discounted future cash flows, is $3,000. So if you look at the first part of the question, it says if the machine is still in use, determine the amount of impairment. And the second part, the second scenario is if the company has been classified as held for sale in the beginning of 2003, calculate the amount of impairment assuming $800 disposal costs. So we're going to look at both the scenarios. The first one, put a box around held for use. Highlight depreciate the asset. So at 31st December year 3, the machine will have a carrying value of $7,000 with accumulated depreciation of $3,000. Highlight test for impairment. Since the carrying value is $7,000 and the non-discounted future cash flows is $3,600, the machine is impaired. And the third one, highlight measure impairment, where impairment equals carrying value minus fair value, which is $7,000 minus $3,000. The impairment loss is $4,000. So let's recap this on the bottom. So, we're going to be creating 3 columns, one for depreciate, test and measure, and right there, held for use. So when the asset is held for use, we do depreciate. So it's going to be $8,000, which is going to be the beginning carrying value as of year 3, minus the $1,000, which is the depreciation for year 3, net $7,000. Now the test here is, is $7,000 greater than $3,600, and highlight $3,600. That's the non-discounted future cash flows. Now the answer is yes, 7,000 is greater than 3,600. That means the asset is impaired. And now that we're going to be measuring impairment, that's going to be $7,000 carrying value minus $3,000 fair value. Highlight that. And $4,000 impairment loss. Highlight that. And right there, recognize an I. That's income from continuing operations after tax. Now, I want you to go up again and look at the second scenario. It says, if the company had been classified as held for sale in the beginning of 2003, calculate the amount of impairment assuming $800 disposal cost. So the fair value is $3,000. The disposal cost is $800. So, just below the box, where we have made a note of carrying value and fair value, I want you to write NRV equals $3,000 minus $800 equals $2,200. And bottom of the page, let's first make notes here, held for sale. Now for held for sale assets, we do not depreciate. So put NA for depreciation. So the carrying value at the beginning of the year for the asset was $8,000 and you don't depreciate any further. Now when you look at the test for impairment, now you're looking at the carrying value which has not been depreciated. Compare that to NRV. So is $8,000 greater than $2,200? Highlight 2,200. And then when it comes to measuring the impairment loss, we're going to have $8,000 carrying value minus $2,200 NRV, which leads to and highlight $5,800 impairment loss, which you need to recognize in D or discontinued operations. Okay, now go back up again where we have solution 2 of 2. Put a box around held for sale. Highlight depreciate the asset, not applicable, as the asset was held for sale during year 3. As of beginning of year 3, the machine had a carrying value of $8,000 with accumulated depreciation of $2,000. Highlight test for impairment, highlight since carrying value is of $8,000 is greater than the NRV of $2,200, naturally the machine is impaired. And the next one, highlight measure impairment. Impairment equals carrying value minus, okay, there's a typo here, scratch of fair value, right, NRV. And that's basically $8,000 minus $2,200 equals $5,800 impairment loss recognized in discontinued operations, because this one's, in this scenario, a held for sale asset.
Now, we just looked at depletion expense. Let's quickly recap. So we said depletion expense is your cost minus salvage value. That becomes the depletion base into the depletion percentage or the units of production percentage, the amount of extraction that happened each period. Now, when we looked at this cost, we said cost, this is the purchase price plus any development cost, and we also added any anticipated restoration cost. Let's put it as present value of anticipated restoration cost. And we're going to focus on this part right now because this is your asset retirement obligation, ARO. So ARO, or the asset retirement obligation, is the legal obligation associated with the retirement of this fixed asset. So let's say it's an offshore oil platform. In this case, the company would have an obligation to dismantle the platform after the end of its useful life. So the cost to dismantle at the end of the useful life is the asset retirement obligation of the company. Let's say it's a nuclear utility plant. For them, the asset retirement obligation is the cost to decommission the plant at the end of its useful life. Let's talk about a waste management company. They've got a landfill where they take in garbage, dump it into the landfill over a period of years. Now, at the end of the life of the landfill, when the landfill is more or less filled up with garbage, they have an obligation, a legal obligation to close the landfill, restore the surface of the land, and let's say they want to build up a children's park over that. So that would be an asset retirement obligation. So it's not an obligation right now, it's an obligation yet to come at the end of the life. But you recognize the liability right now, even though this obligation is going to come after many, many years. Now, what you do is you recognize this liability at its fair value or its present value. You discount it. So let's understand this by looking at an example on the book. So you have Shell company acquires an oil field for cash $500,000. 10 years later, expected land value will be $50,000 and expected restoration cost would be $25,000. Appropriate discount rate shall be 5%. Present value of $1 at 5% for 10 years is 0.675. Okay, so you have the price that they've paid, and on that you have the restoration cost, you have some residual value. So salvage value is basically the residual value. So what you would do in this case is, let's say in year one you would have an initial journal entry. So you've paid out cash, cash has gone out $500,000. And you have bought land. Now this land is going to be worth $50,000. And along with that, there are oil reserves that you're going to deplete as you extract it. And you're also going to recognize a liability. And as I told you, it's going to be at present value or fair value. So when I'm looking at the asset retirement obligation, it said it's going to be $25,000 after 10 years. So how much is $25,000 after 10 years worth today? For that, you'll have to take the present value. We'll talk about present value in FAR 4 in a lot of detail. But for now, what we're doing is we're doing $25,000 into 0.675 because that's the discount present value number for 5% discount rate. So that gives us 16,875. So what we've done here is we have done $25,000 into the present value factor 0.675. The plug, so $500,000 plus 16,875 minus $50,000, that is a depletion base of 466,875. So this is your plug for depletion. Now, what you basically do is this becomes the depletion base for depletion expense. And this is the base for the asset retirement obligation. Now guys, think about it. 16,875 as of today. We're going to grow it so that this number, this liability number becomes $25,000 after 10 years. So you got to add to it something like an interest expense so that it grows. Now this is called an accretion expense. So we're going to grow the 16,875 of liability right now to $25,000 in 10 years. So this is for ARO and this results in accretion expense. So guys, basically on your income statement, you'll have two expenses. First is the depletion expense. Second is the accretion expense for the asset retirement obligation. So you got to grow the 16,875 to $25,000. So let's put it here. Okay, let's do it on that side of the board. We'll have more space there. So every period, so that's your initial journal entry. So every period, so for years 1 to 10, you're going to have a depletion expense to your accumulated depletion. That would be based on your extraction. Remember the activity, units of production. How much did you extract? You're going to deplete it. So you're going to have this accumulated depletion, which would be a contra asset to your oil reserves, such that if you've extracted everything, you'll have an accumulated depletion of 466,875. So this asset becomes zero after 10 years. Now, along with that, I told you you're going to have an accretion expense. So you'll have an accretion expense. Now, this expense would help you grow your asset retirement obligation. So you're going to credit it further so that this number, it grows, becomes $25,000 after 10 years. So let's try to do an amortization schedule. So whenever you have present value, we'll talk about amortization schedules. Let's do a simple one here. So you got 16,875. Let me use blue pen for this. So you got 16,875. What we are saying is the discount rate was 5%. So we're going to grow it by 5% every year. Now 5% of this number would give us 844. Now 16,875 plus 844 gives us 17,719. Now this into 5% gives us 886. This calculates to 18,605. So what we could say is after year 1, this is the obligation number. So this is at year 0. This is after year 1. This is after year 2. This is the value of your obligation. This number, this is your accretion expense. So you'll have 844 in first year, 886 in second year. So you're going to be growing it such that after 10 years, the ARO number comes to $25,000. And at that point in time, you're going to be paying out the cash to make sure you've retired the asset as per your legal obligation. So in this case, Shell company has to restore the oil field. So after 10 years, so this is be years 1 to 10. So in year 10, after the end of the life, they're going to have this asset retirement obligation being cleared out, or basically they'd be paying out cash $25,000 for this. This number gets cleared off. So guys, understand what we did was we recognized this liability at present value. We increased this liability by recognizing an accretion expense every period. We grew this such that it became the actual value after 10 years, at which point it was cleared off, it was settled because it was a asset retirement obligation, a legal obligation for this company. On page
25.
we're looking at asset retirement obligation. So these are legal obligations associated with retirement of long-lived asset, and highlight recognize liability at fair value or present value. And annually you increase the liability by recognizing and highlight accretion expense. Looking at the example on this page, Shell company acquires an oil field for cash $500,000. 10 years later, expected land value will be $50,000 and underline expected restoration cost will be $25,000. Then you have an appropriate discount rate of 5%. The first journal entry, the debit is to land and to oil reserves, the credit is to cash that goes out, and the asset retirement obligation, right, at present value. Highlight $16,875. And right there, grow to $25,000 in 10 years. Then annually, you're going to have an accretion expense, right, each year. Then the actual restoration, highlight after year 10, and you have cash being paid out for the asset retirement obligation. So draw an arrow from where we had written grow to $25,000 to the $25,000 number on asset retirement obligation. Now, we've been looking at a lot of content for a fixed assets, especially PP&E, property, plant and equipment. We went out, we procured PP&E, bought it, put it on our books. We capitalized any capital expenditure which made our PP&E bigger, better or longer. We also capitalized any interest if this was a self-constructed PP&E. Then we looked at depreciating this PP&E over its useful life. We also tested for impairment if suddenly it lost value. Now in this section, let's talk about sale or disposal of PP&E. Let's say we bought the PP&E, we don't need it anymore, we sell it off. So we're looking at disposal of PP&E. Now let us say we got a piece of equipment on our books which we bought for $5,000 but is currently having a carrying value of $2,000. What does that mean? So we bought it for $5,000, it's in our books at a carrying value of $2,000. That means it's got an accumulated depreciation of $3,000. So less 3 would give you a carrying value of $2,000. Now let us say you're selling this off for $1,500. What do you need to do? So first thing, what you would do is you would recognize depreciation up to the point of sale. So let's say you're selling it on the first day of the next year. So then there's no more depreciation. Then you would remove this original cost and this accumulated depreciation off your books. You are selling this equipment off. So PP&E, that's a debit number. You're going to credit it. So PP&E credit would be for $5,000. When I'm looking at accumulated depreciation, that's a credit number. To get it off, you're going to debit this. So guys, understand, 5,000 minus 3,000, this is your carrying value or your book value of $2,000. Now, if you're selling it for, let's say, $1,500, something which is on your books for $2,000, you're selling it for $1,500, gain or loss? Naturally, you're having a loss of $500. So let us say you're getting in cash of $1,500. In that case, you could have a gain or a loss, but now you're having a loss of 500. So this makes it 5,000 debit, 5,000 credit, you're good to go. How about you sold this off for, let's say, $2,500. Something which is on your books for 2,000, you're selling it for 2,500. Now you have a gain of 500 which comes in here. So guys, what I'm trying to say is you would have a gain or a loss, not both. If you're selling it for more than your carrying value, you're having a gain. Less than your carrying value, you will have a loss on sale. Now here, I want to remind you about the concept that we learned when we were doing composite depreciation. Remember, IFRS, it requires component depreciation, each component separately. Now GAAP is okay either with component depreciation or even group or composite depreciation. So in composite depreciation, we had dissimilar assets. Group depreciation, we had similar assets. Now in that case, what we said was, PP&E, this is not one asset. This is a group of a lot of similar or dissimilar assets put together. Now when we are selling a small piece, one of the assets in that entire group or composite assets, we don't want to recognize a gain or loss on sale. In that case, we would assume that whenever we are selling a piece of that composite assets, we are having no gain, no loss. Basically, the cash that we are getting from sale is equal to the carrying value of the asset. So in that case, we would not have any, let's say we're selling for 2,500, we would not have any gain or loss. The accumulated depreciation would be the plug. So in this case, the accumulated depreciation would be, let's say 2,500. So guys, that was a composite depreciation concept that we learned back when we did depreciation. If you don't remember it now, you got to turn back your pages, go back, make sure you nail it. Now let's move on with disposal of PP&E. So we've looked at taking this asset off, selling it. How about we take this asset off? We got a piece of computer equipment which nobody is ready to buy and it's worth nothing. Basically, it's had total impairment. So let's say this asset, 5,000 historical cost and accumulated depreciation of $3,000 is now totally impaired. In that case, you would simply take it off your books and recognize an impairment loss. So you have an impairment loss of the entire $2,000. So that's your plug here. The gain amount was your plug, or the loss. If you sold it for $1,500, the loss was your plug. But if it's totally impaired, you're basically selling it for $0. It's an impairment loss for the entire amount. Now, how about this asset? You're using it, you don't sell it off. But let's say it was an asset with a useful life of 10 years and you've used it for 10 years. The accumulated depreciation is now equal to the value of the historical cost of the asset. Net is 0. So now you simply want to write it off. 5,000 less 5,000 becomes 0 on your balance sheet. No point having this. So that becomes a write-off for fully depreciated asset. So write-off for fully depreciated asset. So in this case, PP&E, that's a debit number. Accumulated depreciation, that's a credit number. You want to write both of them off. PP&E is 5,000, so 5,000 goes off. Fully depreciated 5,000, this goes off. So simply reverse it off. This goes off your books, becomes 0, 0, net 0. So you clean your balance sheet. Let's look at this on the book. We'll also have an example that we're looking at, and then we'll come back and look at involuntary conversions. We're looking at disposal of fixed assets. Highlight recognize depreciation up to the point of disposal. Remove the original cost and accumulated depreciation of asset disposed. And highlight recognize gain or loss on sale for the difference between the carrying value and the sale price. Now you got a journal entry here where the credit is to PP&E for $5,000 and you also have accumulated depreciation which is debited, in this case $3,000. So draw an arrow out from $3,000 and $5,000 and write carrying value of this piece of equipment, that's $2,000. Cash came in $1,500. The difference between $2,000 carrying value and the cash of $1,500, the sale price that's coming in, that's the loss on sale, $500. So we've looked at the sale or disposal of PP&E where you voluntarily converted it to cash. You took it, sold it, got cash in return, converted to cash. Now let's look at involuntary conversions. You didn't want to, but it still got converted. Let's say you got an amazing piece of land. The government, they got their eyes on that. They say, we want to construct a highway here. So what they do, they come in, they exercise their powers of eminent domain and they seize your property, seize your land. So in return, what they do is they give you a few pennies. So guys, involuntarily, your amazing property, your amazing piece of land worth $500,000 was now converted into few $100,000 of cash. So guys, that is an example of involuntary conversion where your property gets seized. How about destruction of property? So you have a warehouse and the warehouse suddenly catches fire. So involuntarily, your warehouse got converted to ashes. So guys, that is again an involuntary conversion. You didn't want any of this to happen, but it happened and you could do nothing about it. So let's look at an example in the book and understand this concept of involuntary conversions. So it says on 9/11, World Company, so fire destroyed World Company's warehouse with an original cost of $1 million. So it was $1 million worth of warehouse with an accumulated depreciation of $275. So guys, PP&E. So if I put the numbers in here, the warehouse had a historical cost of $1 million and accumulated depreciation of $275. So now the warehouse is no more. Guys, once again, this concept of carrying value. What's the carrying value of the warehouse? $1 million less $275. The carrying value is $725. Now it says removal of debris cost $15,000. Now because it got converted to ashes, you got to have the ashes off the place. So you had paid out cash to remove the debris. Then it says on 2nd of January 2011, the insurance company issued check to World Company for $700,000. On 30th June next year, World Company completed construction of a new warehouse for $1.2 million. So we're not concerned about the new warehouse yet. We're looking at the old warehouse which was involuntarily converted. So the insurance company paid them $700,000. So in this year, it was a receivable from insurance company and that was $700,000. So guys, it was a carrying value of $725 and you had to spend another $15,000 for cleanup and you got just $700,000 from the insurance company. What's your loss? Simple, easy. The loss here is $40,000. So if you look at the next year's journal entry, they receive the cash, so this receivable becomes cash and they construct a new warehouse for $1.2 million. So that's all good. Now, let me try to create another example using Caesar, eminent domain. Let's get on the board there. So let us say, when I was talking about that amazing piece of land that you had, you bought that piece of land for $100,000. Now it's worth $500,000, $500,000. The government comes in, seizes this property, and instead of giving you $500,000, $500,000, they simply pay you $150,000. Guys, think about it. Though the historical cost is $100,000, it's worth $500,000 and you get just $150,000 for that. Are you happy or sad? You're very sad. You've lost $350,000. But on your books, 100 becomes 150. So on the books, you actually have a gain of 50. Guys, think about it. The carrying value was 100. The fair value was 500. What you got was 150. Though you have a loss of 350, On the books, it's a gain of $50,000 which comes into your income statement. Now, that's why for tax purposes, you're allowed to defer gains on involuntary conversions. Not for financial accounting and reporting. Here you have 100 gets converted to 150 cash, so you get the 150 cash and there's a 50 gain here. But for tax purposes, you are not required to pay taxes on this right now. You can defer these gains. So we'll give you a few years to go out and use these gains to buy a new property. If you spend these gains on a new property, you might not even have to pay taxes on this. So guys, that is something we'll learn when we're doing regulation, but this could be important in FAR from the concept of deferred taxes, because that creates a temporary difference. So though you're having a gain on your financial accounting and reporting books, you're not having a gain on your tax books, because tax laws allow you to defer this gain, because they know you're really sad because you lost this property. You lost $350,000. Just that you have a gain on your books because your land was at historical cost when you bought it ages ago. We're looking at involuntary conversions. That's a destruction of property or seizure by government entities as a result of condemnation or eminent domain actions. The accounting is similar to voluntary sales and highlight deferral of gains or losses is not allowed. And right there, deferral of gain on involuntary conversions allowed for tax purposes. So this is something we're going to learn about in regulation, that deferral of gains is allowed on involuntary conversions.